We're diving into the S&P 500 and why it's so important when it comes to investing. You've likely heard the term S&P 500 thrown around on various articles, on newscasts, on videos, and you may hear things like, oh, the S&P 500 is up today, or the S&P 500 is down by 200 basis points. What does all that even mean? Well, essentially, the S&P 500 is a super popular stock market index that tracks the 500 largest companies in the US. The best way to think about it is like a snapshot and a health check on how the overall US stock market is doing by taking a look at the 500 largest companies as a representative of the entire population of US stocks. The S&P 500 includes some of the most popular and well-recognized names you've likely heard of. So names like Apple, Microsoft, Amazon, JP Morgan, Alphabet, which is Google's parent company, just to name a few. These super popular large household names cover various sectors throughout the US. Sectors like technology, healthcare, finance, communications, consumer staples, consumer discretionary, industrial, and energy. Historically, the S&P 500 has delivered an average annual rate of return of over 10% since 1957. The performance has been so strong that many fund managers use the S&P 500 as their own benchmark to measure their own success and how good they are at stock picking. And for Canadian investors, getting a piece of that S&P 500 performance has never been easier thanks to products like exchange traded funds, or ETFs for short. And in this video, I'm going to guide you through 3 of the best options of ETFs that track the S&P 500 for Canadian investors. Now, before we jump into my picks on ETFs that track the S&P 500, let me give you some context on what you're actually getting into. Because when it comes to investing your hard-earned dollars, there is no shortcut for doing your own due diligence and your homework before you start investing. One of the great things about the S&P 500 and why I love this index particularly so much is that it makes investing in a bunch of companies with strong performance super easy. And that's why I love ETFs like this and I'm about to show you, is that investing does not have to be complicated to capture great performance. Investing can be simple, it can be automated, and you can actually make a decent rate of return without having to overcomplicate your life. Just imagine you are trying to replicate the S&P 500 and you are going to buy individual 500 stocks. That's 500 individual transactions you would have to make just to measure and track the S&P 500. Or you can buy one single ETF and invest in 500 companies all at once with one single easy transaction. Which one would you choose? Obviously, the one transaction that covers 500 companies. Because if you're going to invest in 500 companies individually, you're going to have a very confused stockbroker. That's going to be a lot of clicking and tracking, and it's just going to overly complicate your life, which is what you don't want. Simple, easy, and efficient. An index, S&P 500, one click, 500 companies. It doesn't get any easier. As I mentioned earlier in the video, the S&P 500 has delivered an amazing performance around 10%, and that's why stockbrokers love to use this as their own benchmark. So let me take a quick example of what all that means. If you had invested $10,000 back in 1980 into a single S&P 500 ETF, today you would have $750,000. That's $750,000 coming off a $10,000 investment. So you can easily see that investing does not have to be complicated. You can capture great, phenomenal returns and keep things simple. So don't let various products like 2x leverage daily returns or this super mega dividend, covered call ETF with a 12-20% distribution. You don't need all of that. You can keep things simple, capture amazing returns, and go on about your life. Now, I know all that sounds great and why you should be investing in the S&P 500, but there's an important point that you have to remember. Past performance does not guarantee future results, meaning even though we've seen historically the S&P 500 deliver an average rate of return around 10% or so, that doesn't mean that going forward you can expect to make 10% each and every year. I'm going to cover that a little bit later why when it comes to investing in the S&P 500. Also, don't forget that diversification is crucial. The benefit of the S&P 500 is that you get to invest in 500 of the largest companies worldwide across various sectors. But that's not the only asset that one should have in a diversified portfolio. You should have or consider things like, do you need exposure to bonds? Do you need exposure to real estate? There's multiple asset classes that pretty much, when you combine them all, make a fulsome portfolio. All right, so enough fluff about the S&P 500. Let's get down to the meat and potatoes of this video. Let's go through the 3 ETFs that I have picked for you that get you exposure to the S&P 500. The first one we're going to talk about is VFV, which is the Vanguard S&P 500 Index ETF. It's currently trading around $135 per share. And when it comes to performance, it is no slouch. Year to date, it has delivered an over 21% rate of return. Over the 5 years, it has delivered an annualized rate of return of just under 16%. And if we stretch the time frame even further, since November of 2012, you would have captured an annual average rate of return of over 17%. As you can see, there are reasons why people love the S&P 500 for some phenomenal growth. And products like VFV make it super easy. Let's keep going. It does pay a bit of a distribution, not a whole lot, but it's something to keep you going. The dividend rate is 1.05% and it is paid out on a quarterly basis. When it comes to its holdings, no surprise, it tracks the S&P 500, so you get exposure to the largest 500 companies in the US across various sectors that make up the S&P 500. This particular index, the S&P 500, who is it for? Who is the ideal investor that should be investing in the S&P 500? Well, if you're seeking long-term capital growth, check. If you are interested in US large cap stocks, check. Third, if you can handle market volatility. As I mentioned earlier, the S&P 500 doesn't mean you're going to get a rate of return flat each year. It's not going to go up by 10% each year. It may go up by 20%, then down by 30%, then up by 15%, down by 10%. So you're going to see these spikes along the way. But over the long haul, it averages out to 10% since 1957, or with something like VFV, it averages out to roughly 17% since November of 2012. The next ETF we're going to cover is ZSP, which is the BMO offering and the aptly named the BMO S&P 500 Index ETF. It's currently trading around $83 per share, and the performance very similar to VFV. Year to date, 21%. Over the 5 years, it has averaged an annual return of 15.65%. And since inception, since November of 2012, it launched around the same time as VFV, so performance is also very similar at over 17% annualized since then. Dividend and frequency, you're looking at about 1.15% in terms of its dividend yield, and you get paid on a quarterly basis. Holdings, again, very similar to VFV. It tracks the S&P 500, so you get exposure to the same stocks that make up the S&P 500. So who should invest in ZSP? Fairly similar to the VFV if you are an investor who's looking for long-term capital growth. If you want exposure to the US large cap stocks. And 3, if you can handle market volatility. And as an example, if you had invested $10,000 in either VFV or ZSP, you would be looking at roughly $66,000 today. Not bad for a $10,000 investment back in 2012. My third and final pick for this video is XUS, which is the iShares Core S&P 500 Index ETF. It's currently trading around $47 per share, and performance fairly similar to VFV and ZSP. Year to date at over 21%. Last 5 years has averaged out just under 16%, and since inception, since April of 2013, is just under 17%. The dividend it pays out is on the higher side compared to ZSP and VFV at 1.89%. However, one little bit of a difference between the two, that XUS pays out on a semi-annual basis, so twice a year, versus quarterly at VFV and ZSP, which they pay out 4 times a year. Holdings fairly similar. S&P 500 exposure to the 500 largest US companies. And who is this ETF for? Same as VFV and same as ZSP. You're looking for long-term capital appreciation. if you are interested in US large cap stocks, and 3, if you can handle market volatility. Now let's compare and contrast between the 3. Let's put it all together in one snapshot and see which one makes sense for you. So here we have VFV, ZSP, XUS, and if you're playing spot the difference, you'll notice that there's not many differences between the 3, and you're going to find more similarities. And if you're looking at the MER ratio, you'll notice that the cost is only 9 basis points across all 3. Now, what does that mean? 9 basis points. That means for every $10,000 you invest in each of these ETFs, that will cost you annually $9, which is maybe 2 or 3 cups of coffee. Not bad for considering the type of exposure you get to 500 large companies in the US and diversification across various sectors. $9, it's a non-factor when it comes to investing. If we keep going, you'll notice in terms of assets under management, VFV and ZSP are the 2 most popular choices at over $16 billion assets under management between the 2 of them, across the 2 of them, and $7.2 billion at XUS. In terms of their tracking methodology, fairly similar. Either they hold a US ETF, which holds 500 stocks, or they hold the 500 stocks directly, which is the approach for ZSP. Exposure is the same. Sector diversification check across all 3. In terms of trading volume, definitely VFV and ZSP are the most popular. Having said that, if you choose XUS, again, you're getting the same type of performance, same meat and potatoes. But really, it comes down to personal preference. You really can't go wrong with any of these 3 options if you're looking for easy exposure to the S&P 500. Now, I'm not going to just leave you with that little bit of a soundbite. What would I choose? My personal preference is VFV. And that's because I'm a big believer in the Vanguard suite of products, what they've done to change the investing landscape, vanilla products, low cost, easy. I'm a big fan of Vanguard, and that's why I would choose VFV. But that's just my personal preference. If you're looking at this, you could swap out VFV for ZSP or XUS, and you really can't go wrong between those 3. So I'll leave you with that. As you can see, investing does not have to be complicated. You can easily invest in the S&P 500 through these ETFs like VFV, XUS, ZSP, and get diversified exposure to 500 of the largest companies in the US. And when it comes to diversification, you don't have to stop right there. You can add things like bonds or real estate to further diversify your holdings if you want to, and if that's part of your financial goals and objectives. Hopefully after watching this video, you can see why I'm a big fan of these 3 ETFs. They're cost-effective, easy to access, and amazing for long-term holding. The last thing I want you to do now is stay connected with this channel. If you've enjoyed this video, hit that like button. If you've enjoyed the content and are looking for more content updates, make sure to hit subscribe for more investing tips, and hit that thanks button on the bottom of this video to support this video and future content. Lastly, don't forget to check out all the links in the description below for resources that supplement this video for further learnings and for discounts on products and services that I use on a daily basis. If you have a question for me and want to ask me privately and get a quick response, make sure to check out this link and ask me, and you can ask me your question and get a quick response. That's all for now. I'll talk to you in the next one.